Updates in managerial accounting. Is there a need? Yes, there is a need to update managerial accounting because the traditional methods, which were primarily designed for manufacturing-centric and stable environments, no longer meet the demands of today's dynamic and technology-driven business landscape. With globalization, rapid technological advancements, and increasingly complex organizational structures, managers require more timely, relevant, and forward-looking information. Updated managerial accounting practices incorporate tools like real-time data analytics, activity-based costing, and predictive modeling to provide deeper insights and support more agile decision-making. Without these updates, organizations risk relying on outdated information that can lead to poor strategic choices and inefficiencies. Managerial accounting remains highly relevant in the modern world as it plays a crucial role in guiding business strategy, optimizing performance, and ensuring resource efficiency. Beyond traditional cost control, it now supports sustainability reporting, risk management, and the evaluation of intangible assets such as intellectual property and brand value. It also helps businesses respond to market volatility, assess new opportunities, and align operations with long-term goals. In essence, updated managerial accounting acts as a bridge between data and strategic action, making it indispensable for modern organizations seeking to stay competitive and responsive. Why updates are critical. 6 key forces reshape the need for modernized managerial accounting. It emphasizes that traditional accounting methods can no longer keep pace with the demands of today's dynamic, data-driven environment. Digital transformation, through cloud computing, IoT, and AI, has drastically increased the volume and complexity of data businesses must process, requiring more sophisticated accounting systems. Similarly, global complexity, including geopolitical risks, varying regulatory environments, and intricate supply chains, necessitates adaptable and transparent accounting practices that go beyond conventional cost tracking. Additionally, the data explosion, with 90% of the world's data created in the last decade, has rendered traditional analysis methods insufficient. This surge in volume, velocity, and variety of data demands real-time processing and strong data governance frameworks within accounting systems. The growing sustainability focus also pressures organizations to track non-financial metrics like carbon emissions and social impact, pushing managerial accounting into new territory. Finally, hyper-competition in the marketplace, driven by lower entry barriers and accelerated innovation cycles, calls for faster, more granular insights to support agile decision-making. All these trends underscore the urgent need to update managerial accounting so it can remain a relevant and strategic tool for modern business leaders.
Traditionally, managerial accounting has been rooted in structured financial oversight, focusing on cost accounting, budgeting, variance analysis, and internal reporting. These practices have long been essential for monitoring costs, assessing performance, and ensuring fiscal discipline. However, the reliance on historical and aggregated data means that traditional managerial accounting offers primarily retrospective insights, essentially providing a snapshot of past performance rather than a tool for forward-looking strategy. The limitations, however, are becoming increasingly apparent in today's fast-paced and complex business environment. Traditional methods often lack agility, making them ill-suited for real-time decision-making. They also struggle with complex cost structures, particularly when dealing with indirect costs in modern organizations. The problem of siloed data, where financial data is isolated from operational or strategic data, further hampers comprehensive insight. Additionally, there's a predictive gap, as these systems don't emphasize forecasting or analytics that support proactive decisions. Finally, the inability to incorporate non-financial metrics, such as environmental or social impact, makes them inadequate for meeting modern demands like ESG reporting. This reinforces the urgent need for updated managerial accounting frameworks that are integrated, agile, and analytics-driven. Managerial accounting is being reshaped by powerful trends that are expanding its role from traditional cost tracking to strategic decision support. Digital transformation, through automation, AI, and data analytics, is enabling faster, more insightful forecasting and performance analysis. At the same time, There's a growing demand for integration of sustainability and ESG factors into internal reporting and cost management. Agile budgeting techniques like rolling forecasts and scenario planning are replacing static annual budgets, while the valuation of intangible assets, such as intellectual capital and brand reputation, is gaining importance. These shifts are pushing management accountants to become strategic partners who not only ensure financial accuracy, but also deliver forward-looking insights, support ethical governance, and drive long-term value creation.
ABC improves cost accuracy by allocating indirect costs, such as utilities, depreciation, or administrative overhead, based on the actual activities that consume those resources, rather than applying broad averages or simple volume-based formulas. This method addresses one of the major flaws of traditional cost accounting: the misattribution of overhead. Traditional methods often obscure the true cost of products or services, particularly in environments with a wide variety of offerings or customer types. ABC allows companies to uncover the true profitability of individual products, services, and even customer segments. This enables more informed decisions regarding product pricing, customer targeting, outsourcing, and discontinuation of underperforming lines. Example: a telecom company implemented ABC and found that customer acquisition costs were being incorrectly assigned, leading to poor marketing ROI. By identifying the true cost drivers, the company reduced misallocation by 30%, which enabled more efficient and focused marketing strategies. ABM builds on the insights provided by ABC. While ABC focuses on assigning costs accurately, ABM leverages that cost data to optimize business performance. It identifies and eliminates non-value-adding activities, improves resource allocation, and streamlines processes to enhance efficiency and profitability. ABM is particularly powerful because it turns costing data into actionable management decisions. It helps organizations reduce waste, enhance productivity, and better align operational activities with strategic goals. Example: a logistics company used ABM to assess its shipping operations. By analyzing ABC data, it pinpointed redundant tasks and inefficiencies in the shipping workflow. Eliminating these steps led to a 15% reduction in overhead and faster delivery times, boosting both cost efficiency and customer satisfaction. ABC and ABM are essential tools for modern managerial accounting because they support strategic agility and cost transparency. As businesses become more service-oriented, digitized, and customer-driven, cost structures grow increasingly complex. Traditional models that rely on blanket overhead rates fail to capture this complexity, whereas ABC offers a granular, activity-based view. ABM complements this by turning data into strategy, helping firms continuously improve and remain competitive in volatile markets. Furthermore, both ABC and ABM promote a culture of accountability. Managers at all levels can see which activities drive cost and which do not add value, enabling better performance management and cross-functional collaboration. These tools are especially valuable in industries with tight margins, rapid innovation cycles, or heavy regulatory burdens.
The rise of data analytics and artificial intelligence (AI) is fundamentally reshaping managerial accounting, turning it into a more proactive, real-time, and insight-driven function. This trend moves beyond traditional backward-looking reporting and places managerial accountants at the forefront of strategic decision-making, leveraging advanced technologies to extract actionable insights from vast datasets. Real-time reporting. One of the most impactful developments is the shift from static, monthly reports to dynamic dashboards that provide real-time financial and operational data. These dashboards allow organizations to monitor performance continuously and respond swiftly to market shifts or operational inefficiencies. Real-time reporting empowers managers to identify variances immediately, enabling quicker corrective actions and improved responsiveness. This is especially critical in fast-paced industries where delayed reporting can result in missed opportunities or prolonged inefficiencies. Example: a global sales team, for instance, may now rely on dashboards that update every 15 minutes, giving decision-makers up-to-the-minute insights on market share shifts, customer behaviors, or sales conversion rates. This allows for rapid adjustments to sales tactics, pricing, or inventory deployment. Predictive analytics. AI-enhanced predictive analytics leverages historical data, statistical models, and machine learning algorithms to project future trends, forecast outcomes, and mitigate risks. In managerial accounting, this has significantly improved the accuracy and reliability of forecasting processes. By increasing the accuracy of sales forecasts by 15 to 20%, companies can optimize inventory levels, minimize stockouts or overstocking, reduce carrying costs, and improve production planning. Predictive insights also support better budgeting and capital allocation. Example, a leading automotive manufacturer has achieved 90% accuracy in predicting spare part demand using machine learning, ensuring better stock management, reduced lead times, and improved customer satisfaction. AI and machine learning applications. AI and machine learning extend the capability of managerial accountants by automating complex analyses, identifying anomalies, and uncovering patterns that would be too subtle or time-consuming for humans to detect. These technologies have been shown to reduce manual variance analysis time by 40 to 50%, freeing up managerial accountants for higher-level analysis and strategic advisory roles. AI's anomaly detection capabilities are also vital for internal controls and fraud detection. Example, in the e-commerce sector, AI is used to flag unusual transaction patterns, helping to detect fraud early and mitigate financial risks. It also enhances customer behavior analysis and personalizes pricing or promotions based on predictive spending trends. The integration of data analytics and AI into managerial accounting represents more than just a technological upgrade, it signals a paradigm shift in the role of the management accountant. No longer confined to reporting historical data, today's management accountants are expected to interpret real-time data for strategic responsiveness, leverage forecasting models for proactive planning, use AI tools for fraud detection and risk management, and contribute meaningfully to cross-functional decision-making. This transformation also necessitates upskilling in areas such as data literacy, visualization tools, like Power BI or Tableau, and familiarity with AI-driven platforms. Organizations that embrace these trends not only improve operational efficiency but also gain a competitive edge through smarter, faster decision-making.
As stakeholders increasingly demand corporate accountability beyond financial returns, environmental, social, and governance (ESG) factors have emerged as critical dimensions of performance. Managerial accounting is evolving to incorporate strategic and sustainability accounting practices that integrate ESG considerations into cost management, planning, and performance measurement frameworks. This trend marks a pivotal shift toward long-term value creation, ethical governance, and resilience in the face of environmental and social risks. 1. Beyond financials, expanding the performance lens. Modern performance measurement no longer focuses solely on financial indicators. Non-financial metrics, particularly ESG indicators such as carbon emissions, energy consumption, employee well-being, diversity, and governance practices, are now embedded into managerial accounting systems. This expanded lens guides long-term strategic planning, enhances a company's corporate reputation, and mitigates risks tied to environmental regulations, social unrest, or ethical lapses. By making ESG data part of routine decision-making, businesses can ensure that sustainability is not a side initiative, but a core driver of strategy. Example, a consumer goods company that tracks its Scope 1, 2, and 3 carbon emissions achieved a 10% annual reduction in energy use. This improvement not only benefits the environment but also results in significant cost savings and strengthens its brand value among eco-conscious consumers. 2. Life cycle costing, holistic cost awareness. Life cycle costing, LCC, is a powerful sustainability accounting method that analyzes a product's total cost from raw material extraction to end-of-life disposal. This comprehensive view helps organizations identify hidden environmental costs and cost-saving opportunities across a product's lifespan. By informing product design and packaging decisions, LCC helps reduce waste, improve efficiency, and meet environmental compliance. It pushes companies to think proactively about the impact of their products beyond immediate production costs. Example, an electronics firm used LCC to assess the environmental and financial cost of its packaging. The analysis revealed significant disposal expenses, prompting the company to redesign its packaging. The result, a 25% reduction in waste and lower long-term costs, demonstrating how sustainability efforts can align with profitability. 3. Integrated reporting, a holistic view of value creation. Integrated reporting, IR, combines financial and ESG information into a single, coherent report, enabling stakeholders to understand how a company creates value over time. It reflects the interconnectedness of financial performance with environmental impact, social responsibility, and governance practices. IR attracts ESG-focused investors, many of whom now prioritize transparency, ethical conduct, and environmental responsibility in investment decisions. This approach boosts investor trust, enhances stakeholder engagement, and improves capital access for sustainability-driven businesses. Example, a publicly listed company adopted integrated reporting and subsequently experienced a significant increase in investments from sustainability-conscious funds. ESG fund growth of 27% in 2022 underlines the rising importance of this reporting approach in global capital markets. Broader implications for managerial accounting. The integration of ESG factors into managerial accounting signifies a shift in how organizations define and measure success. This transformation brings several critical implications. Expanded responsibility, management accountants are now expected to assess non-financial risks, track ESG metrics, and advise on sustainability-linked decisions. Strategic alignment, ESG data is used not just for compliance but as a tool to inform product strategy, operational efficiency, and long-term viability. Cross-functional collaboration, sustainability accounting requires input from environmental officers, HR, operations, and investor relations, demanding collaborative, cross-departmental processes. Increased transparency and trust, integrated reporting strengthens corporate accountability and fosters stakeholder confidence, helping companies maintain their license to operate in an increasingly ESG-aware environment. As business environments become more complex and fast-paced, managerial accounting is undergoing a technological revolution. The integration of automation and digital technologies, particularly robotic process automation (RPA), cloud-based systems, and emerging tools like blockchain, is redefining how accounting functions are performed, analyzed, and delivered. This shift is not just about efficiency, it's about elevating the strategic impact of managerial accounting in organizations through better data, faster insights, and enhanced control. 1. Robotic process automation, RPA, automating repetitive tasks. Robotic process automation, RPA, focuses on automating rule-based, repetitive tasks such as data entry, account reconciliation, journal posting, and report generation. These tasks, once manually intensive, are now handled by software robots or bots. Impact: RPA dramatically reduces human error by up to 90%, increases processing speed, and frees up human capital for higher value tasks such as analysis, forecasting, and strategic planning. This leads to enhanced accuracy and cost efficiency, especially in transaction-heavy environments. Example, in a banking setup, automating invoice processing in accounts payable shortened the AP cycle time by 60%, significantly improving cash flow management and vendor relations. 2. Cloud-based systems, accessibility, scalability, and collaboration. Cloud computing has become a foundational element of digital transformation in finance. By moving accounting software and data storage to cloud platforms, organizations unlock real-time access, scalability, and collaboration across teams and geographies. Impact: cloud-based systems enable real-time financial consolidation and reporting, allowing teams to work simultaneously on live data, regardless of location. This supports remote work environments, enhances security, and ensures business continuity during disruptions, e.g., pandemics or natural disasters. Example, with estimates showing that 70% of finance functions will be cloud-based by 2025, many companies are migrating to platforms like SAP, Oracle Cloud, or Microsoft Dynamics. The need for agility, mobility, and seamless updates makes cloud systems essential for future-ready accounting functions. 3. Blockchain, emerging the future of transparency and trust. Though still in the early stages of adoption, blockchain holds transformative potential for managerial accounting. As a distributed ledger technology, it creates secure, immutable records of transactions, reducing the need for intermediaries and enhancing trust. Impact: blockchain enables greater auditability, minimizes data tampering, and strengthens supply chain traceability, making it a powerful tool for risk and cost management. It reduces disputes, accelerates verification processes, and supports real-time compliance monitoring. Example, pilot projects in the food industry demonstrate how blockchain can trace products from farm to table, improving quality assurance and regulatory compliance. This use case is now expanding into pharmaceuticals, logistics, and manufacturing, where traceability is crucial. Broader implications for managerial accounting. The integration of automation and digital transformation technologies is changing the skill set, mindset, and role of managerial accountants. This transformation carries several broader implications. Redefining roles, routine tasks are being automated, shifting managerial accountants toward roles that require strategic thinking, data interpretation, and business partnering. Data-centric decision-making, real-time and accurate data from cloud and RPA systems enable faster, evidence-based decisions aligned with organizational goals. Security and compliance, blockchain and cloud technologies offer enhanced data integrity, transparency, and regulatory compliance, which are critical in today's audit and governance environments. Cross-functional collaboration, automation tools often require collaboration between accounting, IT, operations, and supply chain teams, creating a more integrated approach to decision-making.
Let's explore each benefit in detail and discuss its broader implications for business strategy, operations, and decision-making. 1. Enhanced decision quality. Data-driven insights lead to optimized strategic choices and more confident leadership. Modern managerial accounting leverages advanced analytics, real-time data, and predictive modeling to support more informed and accurate decision-making. Rather than relying on intuition or historical precedent, leaders can base their strategies on quantitative evidence. This not only improves decision outcomes but also boosts confidence in leadership across the organization. For example, forecasting tools can help executives predict demand trends, allocate resources efficiently, and avoid costly missteps. Impact areas: strategic planning, investment decisions, performance evaluation, risk management. 2. Increased agility. Faster adaptation to market shifts, competitive pressures, and unexpected challenges. Agility is crucial in today's dynamic business environment. Managerial accounting systems that offer real-time monitoring and scenario analysis allow companies to pivot quickly in response to changes in the market. Whether it's a sudden shift in customer behavior or a global supply chain disruption, modern systems can help identify risks early and suggest alternative strategies. Impact areas: crisis management, product innovation cycles, supply chain responsiveness, competitive positioning. 3. Improved efficiency. Streamlined processes, automation of routine tasks, and reduced operational waste. Automation and process optimization are central to modern managerial accounting. By reducing manual data entry and streamlining reporting, teams can focus more on strategic analysis and value-adding activities. Cost accounting tools help identify inefficiencies and areas of waste, while integrated systems reduce redundancies between departments. Impact areas: operational cost savings, time management, human capital allocation, workflow optimization. 4. Greater strategic alignment. Connects operational actions and resource allocation directly to overarching corporate goals. Modern systems ensure that every department's efforts align with the company's overall strategic objectives. Managerial accounting translates high-level goals into measurable KPIs at the operational level. This clarity allows departments to prioritize actions that support long-term growth and competitive advantage. Impact areas: budget planning, goal setting and KPIs, cross-departmental coordination, resource planning. 5. Sustainable value creation. Drives long-term growth by integrating financial and non-financial performance metrics. Sustainability and long-term value creation are becoming increasingly important. Modern managerial accounting incorporates not only traditional financial metrics but also non-financial factors like environmental impact, employee satisfaction, and customer loyalty. This broader perspective supports ethical decision-making and helps organizations maintain stakeholder trust. Impact areas: ESG, environmental, social, governance, reporting. Corporate social responsibility, brand reputation, long-term investment planning. 6. Cost reduction. Early adopters have consistently identified 10 to 20% cost savings through optimized resource use. Cost savings are a tangible outcome of implementing advanced managerial accounting tools. By identifying underperforming assets, unprofitable products, or wasteful practices, companies can streamline operations and reduce costs. The 10 to 20% figure illustrates the significant financial benefits early adopters can achieve, often reinvesting those savings into innovation or growth initiatives. Impact areas: profit margins, budget reallocation, lean management, procurement efficiency. Implementing advanced accounting methods involves much more than just adopting new software. It demands a shift in mindset, skills, and infrastructure. The key challenges are: 1. Data quality. Garbage in, garbage out highlights that data integrity, accuracy, and consistency are crucial for deriving meaningful insights from new systems. Poor quality data undermines even the most sophisticated analytics tools. Errors in data entry, outdated systems, fragmented data sources, and inconsistent definitions, for example, what counts as a customer or unit sold, can produce misleading insights. Managerial accounting heavily depends on accurate, real-time data to support decisions. Real-world implication. Imagine forecasting inventory or profitability based on outdated or duplicate records. It could lead to overproduction, stockouts, or poor pricing strategies. 2. Talent gap. There's a significant shortage of managerial accountants with strong data analytics, AI, and strategic thinking skills. The role of the accountant has evolved. It now demands hybrid skill sets: technical, data science, AI, software tools, analytical, forecasting, decision modeling, and strategic, business acumen, storytelling with data. The fact that only 30% possess these competencies reflects a pressing need for workforce development. Real-world implication. Companies that fail to upskill may fall behind, relying on traditional methods while competitors leverage advanced forecasting and optimization. 3. Resistance to change. Overcoming ingrained habits, traditional processes, and discomfort with new technologies can be a major cultural barrier. Even with the best tools, change won't succeed unless people embrace it. Employees often resist innovations they perceive as threatening their roles or adding complexity. This inertia is especially strong in organizations with long-established processes. Real-world implication. A company might invest in a new AI-based budgeting tool, only to find that managers ignore it and revert to Excel spreadsheets because they're more familiar. 4. Initial investment. Significant upfront costs are often required for new technologies, software licenses, infrastructure, and training. Modernization is expensive, especially at the beginning. It requires not just software purchases but also integration, migration, security upgrades, and perhaps most importantly, training and support for adoption. Real-world implication. Smaller firms or those with tight budgets may delay adoption, missing early mover advantages such as improved agility or cost savings. Hammer and wrench best practices, strategies for overcoming challenges. To succeed in transitioning to modern managerial accounting, companies must deploy strategic, human-centered, and scalable approaches. The recommended best practices are: 1. Phased implementation. Start small with pilot projects, demonstrate clear ROI, gather feedback, and then gradually scale. This method reduces risk and builds confidence. Instead of overhauling the entire system at once, companies test solutions in one department or process, e.g., budgeting, product costing, evaluate results, and iterate before scaling. Benefits: minimizes disruption, allows customization, builds internal case studies for buy-in. 2. Cross-functional teams. Foster collaboration between finance, IT, operations, and other departments for seamless data flow and problem solving. Modern accounting is no longer siloed. It requires interdisciplinary collaboration to interpret complex data, design useful dashboards, and align accounting practices with operational needs. Benefits: breaks down data silos, enhances accuracy and decision relevance, encourages organization-wide ownership. 3. Continuous training. Upskill the workforce in data analytics, AI tools, strategic thinking, and interpretation of metrics. Training isn't a one-time activity. Technologies and best practices evolve constantly, and so must the workforce. By creating learning pathways and certifications, companies empower employees to evolve alongside technology. Benefits: reduces the talent gap, enhances employee engagement, supports a culture of innovation. 4. Strong leadership buy-in. Secure unwavering support from senior leadership to drive cultural change and allocate necessary resources. Transformational change needs top-down endorsement. Senior leaders must not only provide funding but also communicate the vision, model behavior, and hold teams accountable for progress. Benefits: accelerates adoption, aligns vision across the organization, reinforces strategic priorities.
Managerial accounting is rapidly evolving from a historical reporting function into a proactive, strategic partner that drives business value. Traditionally, managerial accountants have been focused on retrospective data, reporting on what happened. But in today's fast-paced, complex business environment, merely explaining past performance is no longer enough. They are now expected to anticipate challenges, model future scenarios, advise executives on optimal paths forward. This evolution transforms managerial accounting into a value creation function, tightly integrated with corporate strategy, performance management, and innovation. Crystal ball future trends, where the discipline is heading. Each trend reflects the shift toward data-driven foresight and personalized decision support. 1. Prescriptive analytics, advising on optimal actions. Increased use of prescriptive analytics, advising on optimal actions. What it means: beyond describing what happened, descriptive, and what might happen, predictive. Prescriptive analytics tells managers what they should do next. Tools involved: machine learning models, decision trees, optimization algorithms. Impact: managerial accountants won't just present options. They'll quantify risks, trade-offs, and consequences of decisions, acting as internal consultants. 2. Embedded AI in ERP systems. Embedded AI directly within ERP systems for automated insights. What it means: rather than requiring separate platforms for analysis, AI will become natively integrated into enterprise systems like SAP, Oracle, or NetSuite. Capabilities: these embedded AIs will flag anomalies, forecast trends, automate reconciliations, and provide proactive alerts. Impact: real-time, automated decision support will become the norm, freeing accountants to focus on higher-value, strategic analysis. 3. Hyper-personalization of reports. Hyper-personalization of reports for specific decision-makers. What it means: reports won't be generic or static. They'll be customized to the role, preferences, and priorities of each decision maker. Examples: a CFO sees liquidity metrics and M&A impacts. A marketing director sees ROI by channel. A plant manager sees unit costs and throughput. Impact: managerial accountants will act more like strategic advisors, curating relevant information to empower quicker, smarter decisions at every level. Repeat button role redefined. Strategic navigators, not just number crunchers. Managerial accountants will become vital strategic partners and navigators. This is perhaps the most profound change: identity transformation. Managerial accountants are now expected to collaborate across departments: finance, ops, IT, marketing. Translate complex financial data into strategic narratives. Use soft skills, communication, influence to advise C-suite decisions. They are no longer background players, but active participants in shaping business direction. Their credibility will hinge not only on accuracy, but also on insightfulness and leadership presence. Rocket call to action. What organizations must do: embrace change, invest in talent, and strategically leverage technology for a sustained competitive advantage. To actualize this future, companies must act decisively. This involves 3 pillars. 1. Embrace change. Acknowledge that legacy processes are insufficient. Foster a culture that is open to experimentation, automation, and agile thinking. 2. Invest in talent. Upskill existing staff in data analytics, AI literacy, business acumen. Hire professionals with hybrid skill sets, finance plus tech plus strategy. 3. Leverage technology strategically. Move beyond tech for tech as sake. Select tools that align with business goals and integrate seamlessly into decision workflows. Adopt a long-term innovation roadmap rather than ad hoc upgrades. Link broader implications. For organizations, gain a sustainable competitive edge through smarter resource allocation, faster reaction times, and improved strategic alignment. Build resilience in times of disruption by relying on data-backed decision-making rather than gut instinct or outdated reports. For managerial accountants, the profession is becoming more intellectually stimulating, collaborative, and influential. Accountants who embrace this shift will find themselves in leadership tracks, not just back-office support roles. All right, we have just discussed the introduction to the updates in managerial accounting. That's the end of our discussion for today. If you have any questions, you may raise your questions in our GC or in our LMS. See you again in the next session. Take care.